On the morning of October 8th, 2025, at 4:47 London time, a single purchase order crossed Daniel Ghali's desk at TD Securities in Toronto. 1,000 tons of physical silver, not futures, not paper contracts, metal. Within 90 minutes, the entire London Bullion Market Association froze, not from a cyber attack, not from a technical glitch, from the sudden, undeniable realization that the metal everyone assumed existed simply wasn't there. Ghali had spent 9 months warning anyone who would listen. In January, he'd published research showing that at current rates, the LBMA was 4 to 7 months from a supply crisis. His models were precise. London's free float had collapsed to 153 million ounces, but the market traded 600 million ounces every single day. The LBMA vaults had lost 33% of their silver since December 2024. That's 827 million ounces down to 778 million by July. The math was extinction level. Wall Street called him a silver bull. Risk managers dismissed his warnings as paranoia. One portfolio manager in London even joked that Ghali's team must be betting on the apocalypse or just bad at spreadsheets. But Ghali wasn't guessing. India had imported 1,000 tons in September alone for Diwali and a social media campaign urging citizens to buy silver instead of gold. That single month consumed more silver than London's entire tradable supply. 5 years of structural deficits, 800 million ounces pulled from stockpiles that no longer existed. Solar panels eating 210 million ounces annually. Electric vehicles, data centers, AI chips. Every ounce dissipated into devices that would never return it to the market. Recycling provided 15% of supply. Mines produced 835 million ounces per year. Industrial demand alone was 810 million. The surplus was 25 million ounces against an 800 million ounce hole. On October 8th, when Metalor, a 171-year-old Swiss refiner operating in 17 countries, announced it wouldn't return to the London market until January 2026, Ghali watched silver lease rates explode from 0.25% to 200% in less than 6 hours. Every major dealer pulled quotes. The paper market discovered it had been trading 4 times more silver than physically existed. The LBMA said they had plenty of silver. The chart said silver was cheap. But the terminal in front of Ghali flashed a message no one in London had seen since 1980. Delivery rejected. Wall Street had spent 50 years trading promises. On October 8th, someone asked for the metal. The freeze wasn't random. It was the culmination of a structural collapse 5 years in the making. Between 2020 and 2025, the global silver market ran cumulative deficits totaling 1.15 billion ounces. That means humanity consumed 1.15 billion more ounces than mines could produce. Every year, the deficit compounded. 251 million ounces in 2021, 237 million in 2022, 184 million in 2023, 282 million in 2024. The Silver Institute confirmed these numbers. This wasn't conspiracy. It was inventory accounting. Where did that billion ounces come from? Government stockpiles liquidated decades ago, ETF redemptions that barely moved the needle, and paper promises. The LBMA runs what's called an unallocated system. Multiple claims on the same physical bars. In May 2021, the LBMA admitted an accounting error that overstated holdings by 3,300 tons. They reported silver they didn't physically have. By October 2025, the system had been running on fumes for years. Of the 844 million ounces reported in London vaults that month, 551 million were locked in ETFs like SLV and PSLV. Legally segregated, untradeable. Subtract those and you're left with 293 million ounces. But banks had hedges and unallocated claims, consuming another 140 million ounces. The real free float? 153 million ounces. Daniel Ghali's January warning had quantified this exactly. Now consider what London actually does. The LBMA's own first quarter 2025 data showed daily gross turnover of 600 million ounces. That's not a typo. 600 million ounces traded every single day against a free float of 153 million. The market was trading 4 times its available supply daily. It's a poker table with $100 in chips but $400 in bets. It works until someone asks for cash. On October 8th, India asked for cash, 1,000 tons, 32.15 million ounces, 21% of London's entire free float, in a single order. The desk couldn't fill it. Metalor walked away. Lease rates exploded because banks suddenly realized they'd lent metal that belonged to 6 different parties simultaneously. The emergency airlifts from New York and Shanghai bought 90 days. But the deficit math doesn't care about airlifts. Mines produce 835 million ounces annually. Industrial demand alone is 810 million. That leaves 25 million ounces of surplus against an 800 million ounce cumulative hole. The LBMA vaults just lost 33% of their silver, and the free float crisis isn't a forecast anymore. It's already here. The panic that seized London in October wasn't about speculation or volatility, it was about physics. Silver isn't like stocks or bonds where you can create synthetic exposure indefinitely. It's a physical element with fixed atomic properties, and those properties make it irreplaceable in the technologies driving the modern economy. Solar panels require 20 grams of silver per unit because nothing else conducts electricity with the same efficiency at the same cost. Electric vehicle battery contacts need silver alloy because copper corrodes under high voltage cycling. AI data centers consume 30 million ounces annually in silver solder and connectors because thermal conductivity at microscale junctions demands it. These applications are dissipative. Once silver is embedded in a solar cell on a rooftop in Arizona or a circuit board in a data center in Virginia, it's economically unrecoverable. You can't melt down a solar panel the way you melt jewelry. The silver is chemically bonded to silicon and glass in quantities too small to extract profitably. This is why recycling only provides 15% of annual supply, and that rate is falling every year as silver gets spread thinner across billions of devices. Industrial demand in 2025 consumed 810 million ounces. Solar alone took 210 million, growing 10% annually as countries race to meet climate commitments. Electric vehicles doubled their silver consumption from 2024 to 2025, hitting 50 million ounces. Every percentage point of EV adoption adds millions of ounces to baseline demand. These aren't cyclical industries that contract during recessions. They're structural, policy-driven, subsidized by governments that have committed trillions to decarbonization. The silver goes into the ground, onto rooftops, into batteries, and never comes back. Now, layer investment demand on top. Coins, bars, and ETFs added another 120 million ounces in 2025. Total demand, 930 million ounces. Total mine supply, 835 million ounces. That's a 95 million ounce deficit in a single year, and we're not starting from zero. We're starting from 800 million ounces underwater from the cumulative shortfall between 2021 and 2025. The LBMA airlifts in October moved 53.88 million ounces into London from New York and Shanghai. That's 6% of the annual deficit. It bought time, not supply. Metals Focus projects global identifiable inventories will fall to 35,000 tons by year-end 2025. That's 1.13 billion ounces total. Meanwhile, annual demand is 1.2 billion ounces. The inventory pool is shrinking faster than mines can refill it, and industrial consumption is accelerating. There's no scenario where this resolves without price revaluation or demand destruction. The trap is already closed. When the October freeze hit, the response was immediate and coordinated. Cargo planes started landing at London airports within 48 hours, carrying silver from 3 sources that Wall Street assumed were bottomless. COMEX registered inventories in New York dropped 1,629 tons between late September and early November. That's 52.4 million ounces drained from the primary U.S. silver vault in 6 weeks. Traders paid premium freight rates to airship 1,000-ounce bars across the Atlantic on commercial passenger airlines because normal sea freight takes 10 days, and they needed metal in 48 hours. The London-New York arbitrage spread had blown out to $1.10 per ounce, meaning London spot prices were trading higher than COMEX futures. This is an inversion that only occurs during physical scarcity. Banks were paying to move metal against the normal flow, which historically runs from London to New York for industrial use. China's role was murkier, but confirmed. Shanghai gold exchange inventories plunged 193 million ounces since their 2020 peak, with accelerated outflows in the fourth quarter of 2025. Industry insiders reported that China Gongmei Supply Chain, the state-linked conglomerate controlling 80% of China's silver import and export flows, coordinated shipments to London through its LBMA partnerships. On October 8th, JP Morgan leased 4,000 tons from ICBC, Industrial and Commercial Bank of China, the world's largest bank and an LBMA clearing member. That silver didn't come from Shanghai's official exchange inventories. It came from Chinese bank vaults in London or undisclosed PBOC strategic reserves. The lease terms were 3 months. JP Morgan must return the metal by January 2026. They won't be able to. The third source was even stranger. India, normally the world's largest silver importer, actually shipped silver back to London in October because London premiums spiked so high it became profitable to reverse the trade. This is like selling water to a man in the desert because the guy next to him is offering 50% more. It doesn't mean there's more water. It means both deserts are dying of thirst. By October 31st, the LBMA reported total holdings recovered to 26,255 tons, an 844 million ounce total. That's a 6.8% month-over-month increase, the largest single-month inflow in 9 years. Wall Street declared victory. Silver prices retreated from $54 to $48. But analysts at Silver Trade published a report stating they were fairly incredulous that the LBMA somehow increased vault holdings by 6.8% in the face of a historic shortage. Multiple sources cited the LBMA's 2021 precedent when they overstated inventories by 3,300 tons to calm market fears. The airlifts simply redistributed a shrinking pool. They didn't create new supply, and with industrial demand growing 3% annually, 2026 will be worse. Every crisis gets compared to the Hunt brothers. On January 21st, 1980, silver hit $50 per ounce when Texas billionaires Nelson Bunker Hunt and William Herbert Hunt tried to corner the market by hoarding physical silver in COMEX futures. They accumulated 200 million ounces through leveraged positions. Regulators crushed them. The CFTC raised margin requirements 500%, forcing liquidation. Silver crashed 50% in 4 days. Wall Street wants you to believe 2025 is the same story. Speculators pumping a bubble that regulators will pop. But 1980 was artificial manipulation by individuals using borrowed money to distort price. 2025 is structural scarcity caused by irreversible industrial consumption. When the Hunts were forced to sell, the silver reappeared. It never left the vaults. Today's deficit isn't about hoarding. It's about solar panels consuming 210 million ounces that are now embedded in glass on rooftops across 3 continents. That silver isn't coming back. The chemistry is permanent. The critical difference is this. In 1980, supply existed and price was manipulated. In 2025, supply doesn't exist and price is suppressed. COMEX commercial traders, primarily bullion banks, hold the second largest net short position in silver history. As of November 2025, bank shorts equal approximately 836 million ounces. If they're hedged 1-to-1 against LBMA physical holdings as they claim, that leaves London's free float at 7.5 million ounces, enough to cover 18 minutes of daily London trading. More likely, the hedges are incomplete. Banks are naked short, betting silver prices stay suppressed through paper contracts, never expecting physical delivery demands. Keith Neumeyer, CEO of First Majestic Silver, one of the world's largest primary silver miners, stated in November 2025 that paper trading can't hide reality anymore. After 5 years of structural deficit, silver's paper illusion is cracking. On October 15, 2025, the U.S. Geological Survey officially designated silver a critical mineral under Section 232 of the Trade Expansion Act. This classification is reserved for materials essential to national security. The Pentagon knows silver is strategic for defense manufacturing, missiles, electronics, radar systems, and domestic supply is threatened. This mirrors China's 2025 export restrictions on antimony and tungsten. Nations are preparing for resource competition. When the U.S. starts stockpiling silver, as Section 232 allows, that's another 50 to 100 million ounces removed from the market annually. Supply that retail investors and industries will never see. Silver's real inflation-adjusted high is $215 per ounce, the 1980 peak adjusted for purchasing power. At $48 today, silver is 78% below its historical value. The Hunt brothers failed because they fought the government. In 2025, the market is fighting physics, and physics always wins. 3 scenarios emerge from here, each with different timelines but the same endpoint. The first is managed decline. Authorities use every policy tool available: LBMA emergency lending, COMEX margin hikes, coordinated ETF liquidations to slow the crisis. Silver stabilizes between $50 and $60 per ounce as industrial users scramble to secure long-term supply at any price. Physical premiums widen to $8 to $12 per ounce. Retail investors can't source 1,000-ounce bars. Only institutions with vault relationships get metal. This is the soft default, where the paper price keeps trading but physical delivery becomes selective. Most likely, timeline is first quarter 2026. The second scenario is forced revaluation. A major industrial buyer publicly declares they can't source silver for production. Media coverage triggers investment demand. Retail buyers flood bullion dealers. ETFs see 100 million ounce inflows in a month. LBMA free float drops below 100 million ounces. Lease rates hit 100%. London suspends silver trading temporarily. When trading resumes, silver opens between $85 and $120 per ounce. Mines that hedge production at $28 go bankrupt. Unhedged miners like Keith Neumeyer's First Majestic see equity gains of 300 to 500%. Timeline is late 2026 through 2027. The third scenario is systemic break. A sovereign buyer demands physical settlement of 500 million ounces or more from LBMA or COMEX. The exchanges can't deliver. Force majeure declared. All contracts settled in cash at reference price. But what's the reference when physical silver is unavailable? The LBMA system fractures. Shanghai becomes the new price discovery mechanism, trading $20 to $40 per ounce above Western paper prices. Not all silver is equal. SLV holds unallocated silver. You own a claim, not specific bars. PSLV holds allocated audited bars in Canadian vaults, redeemable for physical. Physical coins and bars guarantee possession. Position in unhedged miners. Companies like First Majestic produce silver without forward selling production. When spot prices spike, their margins explode. Track the LBMA free float weekly. Watch for total holdings dropping below 800 million ounces. Watch for ETF holdings rising faster than total holdings. Watch for lease rates staying above 5%. If you see all three, the next leg is imminent. January 2026 arrives in 22 days. JP Morgan must return 4,000 tons to ICBC. They can't. When 600 million ounces of daily paper trades face 150 million ounces of deliverable metal, physics sets the price.